Well, everyone, I just found something very, very interesting pertaining to dividend stocks, and I had to let you know in the spirit of this YouTube channel, which is to share knowledge as I grow my own knowledge set in investing and share it with the YouTube channel out there. But first, I wanted to actually bring up a really cool thing. Yesterday, we hit 420 subscribers. Right now, as of filming this video, we're hit 440 subscribers. So that actually is 20 subscribers in a day. But I wanted to do the math around that because you know me, I love investing. I love compound interest, right? So 420 divided by 20 is approximately 4.7%. Now, before we proceed to the main course of the video, I actually wanted to bring you over here to the iPad so that we could work out some compound interest together. Now, of course, I love using this daily compound interest calculator. We can do it on a week's basis, a month's basis, a year's basis to figure out what our peak prime example for investing rates should be. But I wanted to use it today just to count our subscriber count. So principal amount, and let's substitute subscribers for dollars here, right? 420 subs at an interest rate of 4.7% daily over 3 months, and I wanted to show you how hyperbolic we are. Truly the fastest growing YouTube channel on YouTube right now at a growth rate of 4.7% per day. I can hardly believe it. So in 3 months, look at this. We're going to be at 28,730 subs. So everyone, I thank you for being part of the original 420. And without further ado, let's get into the video because I had an interesting chart to show you right here. And of course, this comes from, I'm on the wrong camera. And of course, this comes from Investopedia. And what is this? This is the period that dividend stocks follow. Declaration date, ex-dividend date, date of record, and pay date. Now, how can we utilize this chart to help? I keep switching to the wrong camera. Sorry about that. How can we utilize this chart to make a ton of money? Well, of course, I never really thought about it, but the actual price of the dividend stock tends to move a lot around this time period. Around the X date, the price of the stock ends up moving quite a bit. And I didn't really ever consider that. I thought, oh, dividend stocks are, old in their prime blue chip stocks that don't really have much price action movement on the value of the stock side because they pay out a dividend, whether that's a 2% dividend, a 3% dividend, or a 5% dividend, right? Like AT&T, you can go look at the historical record, is a very stable stock, doesn't really move much in the price action realm, but around the X date, there actually is some movement. And today I'm going to read a little bit from this Investopedia article about how to use the dividend capture strategy. And this is something that I didn't ever really consider, but you know me, I'm really obsessed right now with IEP, Icon Enterprises. I've been shorting the stock, I've been going long the stock, I've been day trading the stock, I've been swing trading the stock a little bit. And today, right now, let me look at my other watch. I have 2 watches. Let me look at my other watch. It's Thursday, the 18th. And on Friday, Friday is actually the ex-dividend date. So this was the last day to hold the stock overnight to capture the dividend and be on the list for the $2 per share dividend or the 23% per year dividend. So that's what made me bring this up because I thought about it. I thought, do I want to hold Icon Enterprises stock for the dividend? That's a pretty juicy dividend, but not until I started to do research, I realized that around the ex-dividend date, what is bad for day traders is the stock price usually comes down the amount of the dividend. And of course, that does make sense. You can't come in the last day to get on the registry for the dividend, come in, hold the stock for a day, and then sell it tomorrow and garner that, in this case, 23% dividend. There actually is a trade-off here. And that's because after the ex-dividend date, the ex-dividend means you can no longer get the dividend of the last period when you buy the stock. The value of the stock is, frankly, lesser the dividend. So if Icon Enterprises, for instance, is paying 23 divided by, is paying like a 7% dividend, more like 6% dividend, in a quarter, then on the ex-dividend date, that stock, in theory, is going to drop about 6% to compensate for the lost value. And the same thing goes for, let me just show you the date here again, on the declaration date. On the declaration date, stocks usually tend to go up the amount that the dividend is going to pay out. So in this case, IEP would go up 6% on the next declaration date, just because the stock is actually worth more. Because if you start buying it at that point, you're going to be due to the next dividend. And I just wanted to let us come to this article and read it a little bit. Let's start. Let's begin. How to use the dividend capture strategy. The dividend capture strategy is an income-focused stock trading strategy popular with day traders. In contrast to traditional approaches, which center on buying and holding stable dividend-paying stocks to generate a steady income stream, it is an active trading strategy that requires frequent buying and selling of shares. The underlying stock could sometimes be held only for a single day. And let me show you here. The stock price the dividend gets declared. Okay, here's what we're going to pay per share on the declaration date. And then all up into this point, until the X date, the day before the X date, you can buy the stock and then be eligible to receive the dividend on the pay date. But let's continue reading, and we're going to talk about what I was just talking about. And we're going to read further into what Investopedia has to say. Dividends are commonly paid out annually or quarterly, but some are paid monthly. Traders using a dividend capture strategy prefer the larger annual dividend payouts, as it is generally easier to make the strategy profitable with larger dividend amounts. Dividend calendars with information on dividend payouts are freely available, and there are literally companies paying dividends every single day. So the opportunity is endless for the strategy. So key takeaways. A dividend capture strategy is a timing-oriented investment strategy involving the timed purchase and subsequent sale of dividend-paying stocks. Dividend capture specifically calls for buying a stock just prior to the ex-dividend date in order to receive the dividend, then selling it immediately after the dividend is paid. So for instance, to boil it down really simple, let's talk about Icon Enterprises, which ex-dividend date is tomorrow. If I were to say buy 100 shares today, prior to the ex-dividend date, I could buy in pre-market, at the market, or in post-market today, this date, Thursday, May 18th, I would then be eligible to receive a $2 per share dividend come the pay date. I believe it's on June 10th. But I have to hold the stock. I have to hold the stock for at least that period. I can sell it tomorrow and still claim the dividend on June 10th, even though I held the stock for 12, 18, 24 hours, right? But what I can't do is I can't hold the stock and then sell it before days close today on the 18th, because I need to be holding it to be on the record at the total end of the stock market, the day prior to the ex-dividend date. So that's precisely how it works. The purpose of the dividend capture strategy specifically calls for buying a stock just prior to the ex-dividend date in order to receive the dividend, then selling it immediately after the dividend is paid. However, that's wrong. You can sell it right after, on the ex-dividend date. So you can just hold it 12 hours, like I just said. The purpose of the two trades is simply to receive the dividend as opposed to investing for the long term. Because markets tend to be somewhat efficient, stocks usually decline in value immediately following ex-dividend. The viability of the strategy has come into question. Let me repeat that again. Because markets tend to be somewhat efficient, the value of the dividend paid seems to drop the price on the ex-dividend date because the stock is literally worth less. If you're to buy the stock on the ex-dividend date or after, you're not entitled to that next dividend payout. On the flip side, if you were to buy a stock on the declaration date when they say, hey, here, we're going to be paying $1 per share dividend, then the value of that stock is inherently priced up at a premium of $1 because you'd be entitled, if you were to buy the stock, you'd be entitled to the next dividend. So that's essentially how that works. Now, one last thing And we did cover the timeline here, the declaration date, ex-dividend date, date of record, and pay date. I'll link this article below in the YouTube bio description. And also feel free to drop a like or subscribe if you kind of like me breaking down a little bit of these things. So I've told you how the strategy works. You can also use options contracts to utilize this strategy, which my next video is actually somewhat about this, using option contract strategy, that coming up later today. We're going to read a real world example again. As a historical example to illustrate dividend capture, on April 27th, shares of Coca-Cola were traded at $66.52. The following day, on April 28th, the board of directors declared a regular quarterly dividend of 47 cents, and the stock jumped from 41 cents to 66.93. Right on the declaration date, the stock literally jumped nearly the amount of the quarterly dividend. Although theory would suggest the price jump would amount to the full amount of the dividend, general market volatility plays a significant role in the price effect of the stock. And why does this work? Well, we explained the value, the literal inherent value of the stock changes based upon when the dividend is being paid out. There was one thing, important note. If dividend capture was consistently profitable, computer-driven investment strategies would have already exploited this opportunity. And that's the final note that I wanted to make. Okay, let's say that I bought 100 shares of the stock today, and then I held it until the ex-dividend date tomorrow. And let's say I was going to make a 5% dividend, right? Based on IEP paying 20%. I'm making a 5% dividend by just holding a stock for 12 hours. That seems like a great deal, doesn't it? Well, because of this value shift and because of the usual price decline, it's kind of ingrained in the market that the market is going to take the stock down 5% tomorrow, right? So I may be getting a 5% dividend in a month or two when the dividend is actually paid out, but I will be losing theoretically 5% of value on the stock price tomorrow. So that's why this dividend capture strategy really doesn't work and isn't consistently profitable, because the price fluctuates to match that value of the stock price. So I just want to make this quick video and talk a little bit about this new insight that I had, because I never really thought of it like that. I never really thought of the price fluctuating around the dividend. So that's very interesting. Look up AT&T, look up IEP, look up other dividend stocks on the dates that they're paying their dividend and on the dates that they declare their dividend, and you'll see there's usually a big price fluctuation, which is absolutely insane. And everyone, I want to thank you for watching. In the next video, we'll be talking about some option contracts that I've bought to hedge against this fault in the dividend capture strategy. Okay? Well, everyone, thank you so much for watching, and I hope you have a good one. Bye.